Okay, we're going to talk now about Chapter 7. This is dealing with accounting for receivables. As your book states here, a receivable, let me see if I can get this text size bigger. Alright, not sure why that's not getting any bigger. Anyway, a receivable is any amount that is due from another party, and the two most common receivables are accounts receivable and notes receivable. There are some other examples that are given here, but generally speaking, the two that you will see the most often are accounts receivable and notes receivable. Accounts receivable are any amounts that are due from customers for sales on credit. So you sold them the material, they agreed to pay you, but they have not paid you yet. They didn't pay you in cash. So we're going to talk in this section about how you account for those types of receivables. So first of all, you have to recognize it, meaning you made the sale, and you have to show it in your books as being a sale that's been on credit. So here we have sales on credit, and the way that we do this from an accounting perspective is that you make a debit to accounts receivable, so you're increasing an asset, increasing accounts receivable, and then your credit is going to be to a revenue account, a sales account of some sort. So here it explains how to go about doing that, and down here is your journal entry that shows accounts receivable is debited and sales is credited. This sales account could be named several different things. It may not say the word sales, but it may say revenue, it may say revenue from something in particular. So just be aware that it is a revenue account, and you're increasing the revenue here because you just made a sale, you made money. So to increase a revenue account, you credit it, and to increase an asset account, because the accounts receivable becomes an asset, you debit it. Now when this person pays you, you're going to get cash, and so you debit cash because your cash is increasing, and that's an asset. But you credit accounts receivable because what is now happening is you no longer have this much in accounts receivable. It is being reduced. So debit to cash to increase the cash you have, but a credit to accounts receivable to decrease the amount of accounts receivable. That's the very basic entry that is made probably the most often in businesses that sell things on credit, sell merchandise on credit, is debit accounts receivable and credit the revenue account, and then when you actually receive the money, you're going to debit cash and then credit the accounts receivable. That's kind of the basic entry. There's a lot of variations to this which are discussed in this particular chapter. Another piece of this is the fact that nowadays people often are not just making an arrangement between two companies, but they're using credit cards to pay for things. And a particular company might maintain their own credit card, and the customer utilizes that credit card to purchase things from them. And in that case, there's going to be some other things that are going to be involved, because there's all different types of fees and things like that that come into play in this situation. In reference to credit card sales, many stores, like department stores, have their own credit cards, and when they have customers use those, then of course they may end up getting interest because the customer may not pay off the bill all at one time. If interest comes into play, then you also have to have an interest receivable account and an interest revenue account. If the customer owes $10 in interest on a particular month, that's interest receivable because you haven't received it yet. When you do actually get paid that interest, then you would debit cash and you would credit the interest receivable account to clear it out of interest receivable. But as you all know, most most people today carry a credit card from a third-party vendor, such as Visa, MasterCard, or American Express. And in this case, all of that is handled by the credit card company. The J.C. Penney's of your world don't have to worry about whether or not this customer is creditworthy. They don't have to track them down for bad debts and things like that if the person has paid on one of these types of credit cards. So the majority of credit today in that sense is done with one of these third-party cards as opposed to like a regular department store credit card. Now here in your textbook on page 305, it shows how to account for these credit card sales. So your book tells us that it depends on whether or not the cash is received immediately on deposit or the cash receipt is delayed until the credit card company makes the payment. In this case, if the cash is received immediately on deposit, they give an example. If TechCom has $100 of credit card sales with a 4% fee, and its $96 cash is received immediately on deposit, this would be the entry. Cash is received, that's debited, but credit card expense is also debited because you're increasing the amount of expense, and then the sale is still $100, but it's split between $96, which you get in cash immediately, and $4 that goes to credit card expense. If the cash is not received immediately, meaning you don't get the money right away, you have to wait till it takes a few days for the credit card company to make payment, then instead of cash being debited, the debit goes to accounts receivable. You still have a $4 credit card expense, you still have a $100 sale. The only difference here is that you don't actually have the cash yet, but what you do have is a receivable, meaning you have a promise for somebody to send you this money. Now, if you do it this way, when you actually do get the cash, you have to debit cash, again, for $96. That's the amount that you're going to get. And then your credit goes to accounts receivable, taking it back off the books. This is how it would be handled if you're not receiving the money immediately. Now, we also have something called installment sales and receivables, and this is where a company allows their credit customers to make periodic payments, meaning that you borrow the money and you owe them that money, so you've created a receivable for them, but you don't have to pay all of it at one time. You pay it over time. So these are referred to as installment accounts, and you would pay it off so much a month over a certain number of years. That might be something like a car that you would be purchasing, that you don't borrow it and then have to pay a lump sum in 30 days or something like that, but you get 5, 6, 7 years to pay this off over time. Now, one of the things that you have to do in accounting for receivables is you have to value the accounts receivable, meaning sometimes people aren't going to pay you. So even though they've made that promise, you're not going to get all of the money. And those accounts are referred to as being uncollectible, or they're bad debts. And GAAP expects us to make some type of account for those things so that we're not listing them as an asset that we're never going to receive. So the total amount of an uncollectible account is an expense of selling on credit. If you didn't grant people credit, you probably would reduce your sales tremendously because so many people just don't have the cash up front to be able to buy the things they want to buy. So there's two different ways to account for those uncollectible accounts. There's the direct write-off method and there's the allowance method. In the direct write-off method, you figure out which accounts that you just know are not going to be collected. You're not going to try to predict the amount of your bad debt expense that you might have over time. You're just saying, we know this particular account is not going to be collected, so you just go ahead and write that particular account off. In this case, what you do is debit the bad debt expense account and you credit accounts receivable for the particular account that you know you're not going to get the money for. So it increases your expense on your income statement, and it also decreases the asset of accounts receivable because you know that you don't have that money coming to you. However, sometimes a person does actually come through and end up paying you for an account that you've already written off. So in that case, you have to, in essence, reverse that entry. So in order to do that, you would go back and do two different entries. You would reverse the one up here by debiting, accounts receivable, so you're increasing the receivable again, crediting bad debt expense because you want to reduce the amount of the expense. And then when you get the money, you would debit cash, just like you normally would do when you receive money on an account, and you would credit accounts receivable. So if it does have to be reversed, it's a simple way to do that. It just takes 2 steps to make that happen. And there are companies that utilize the direct write-off method. However, most people use something called the allowance method. And the main reason for that has to do with the principles of accounting, the matching principle and the materiality constraint that are involved in those things. Matching principle, when it's applied to bad debts, requires that your expenses be reported in the same accounting period, we've already talked about this in the past, as the sales that they help produce. So if you're extending credit in a particular period, accounting period, and you're making sales because people are buying things on credit, then it's possible and probably likely that at least some of those sales are going to end up being bad debts, but you don't necessarily know which ones. And so what you end up trying to do is predicting or estimating what percentage of those sales may end up not following through and that you don't get the money. It does become a bad debt. So this concept of trying to match the expense with the revenue is why we look at a particular period and try to estimate or predict how much of those sales might end up in bad debts. The other thing that we have to think about is the materiality constraint, because we can ignore it if its impact on financial statements is unimportant. If it's really not going to make a difference, then based on materiality, it permits the use of a direct write-off method. So if it's really not going to make a real difference in your net income, then GAAP principles allow you to just use the direct write-off method. Otherwise, you're expected to use the allowance method for estimating your bad debt expense. So the allowance method matches the estimated loss from uncollectible accounts receivables against the sales that they help to produce. So we have to go about estimating it, and the allowance method, there's a way we go about doing that. So there's 2 advantages to it. It records the estimated bad debts expense in the period when the sales are recorded, and it reports accounts receivable on the balance sheet at the estimated amount of cash to actually be collected. So we get the expense in the right period, and we also get accounts receivable more exact because we're accounting for that possibility of losing some money because of bad debts. So in this case, what you do is you come up with an amount that you think might be considered a bad debt, and the entry for that is to debit the expense account, bad debts expense. But the credit doesn't go directly to accounts receivable. The credit goes to an account called allowance for doubtful accounts. And this is a contra account to your accounts receivable account. So you estimate, we think we're going to have $1,500 in what we've sold this year to be bad debt. So we're going to put that into the bad debt expense account, but then the credit goes to this account called allowance for doubtful accounts. So the bad debt expense of $1,500 in this case is reported on the income statement, But the allowance for doubtful account is a contra asset account, and it goes on the balance sheet. So you're not reducing accounts receivable directly, but you are putting into your balance sheet a credit here that is a contra account to this debit in accounts receivable, to try to, to make that allowance for what accounts receivable you're actually going to receive. So the allowance for doubtful accounts, the credit balance, has the effect of reducing accounts receivable to its estimated realizable value. So this is what we actually think we're going to realize, and the proceeds we're actually going to get from that amount of accounts receivable. So anyway, this goes on to explain different ways that it can be reported on your balance sheet and those kinds of things. Writing off a bad debt. When specific accounts are identified as uncollectible, they are written off against the allowance for doubtful accounts. So if you are using the estimated method, but then you're able to identify a specific account that needs to be written off, you don't write it off to accounts receivable, but you write it off here. You don't write it off to the expense account, you write it off to the allowance for doubtful accounts. So there would be a debit to allowance for doubtful accounts and the credit to accounts receivable. So you've now identified an actual account, in this case J. Kent's account, $520, and this is the entry that you would make to record that particular transaction. So the bad debt expense account is not debited because you've already done that. You did that when you did the allowance for, when you estimated the allowance, you did it up here. So that's why the debit now goes to allowance for doubtful accounts, not directly to bad debt expense. So this shows you what it would look like in your T accounts. You made your allowance here $1,500, but then in January, when one of those accounts actually did become uncollectible, you debit it here, and then the credit goes to accounts receivable directly. Again, in this situation, you could actually have this customer come back and pay you when you really thought it was completely uncollectible. And this is the way you would reverse that if you're using the estimated system, as opposed to just doing a direct write-off. So they show you here how to reverse what you did originally, and then how to go about recording the payment on account. So again, the only difference is that you're using allowance for doubtful accounts instead of the bad debt expense directly. This just talks about why PayPal has become more and more popular. So for those of you that use PayPal, it might be worth taking a look at. Now, there's another system for estimating bad debts, which is a percentage of sales method. So when you're trying to estimate how much to put toward bad debts, that these are people that are not going to pay you, you're not going to go through all of your credit accounts and try to determine, oh, well, this guy might pay or this guy may not pay, especially if you have hundreds and hundreds of sales on account. So what we do generally is come up with a way to go about estimating that. And so the percent of sales method is one of those ways of doing it. So one's based on the income statement relationship between bad debt expense and sales, and the other is based on the balance sheet relationship between accounts receivable and the allowance for doubtful accounts. Percent of sales method is referred to as the income statement method, and it's just based on the idea that a given percent of a company's credit sales will be uncollectible. So they give you an example here of a company called Musicland, has credit sales of $400,000 based on their past experience. And this is key, because often this is what you have to use. What has your experience taught you over the years regarding what sales will not be collectible? And in this case, it's less than 1%, 0.6%. of credit sales will be uncollectible. So they take their $400,000, they multiply it by the 0.6%, and they decide that $2,400 is likely to be uncollectible, and so they would debit bad debt expense for $2,400 and credit allowance for doubtful accounts for $2,400. Now, this is probably not going to work out to be the exact amount. It's just an estimate that you're making. And that's what this talks about here, is what you might go about doing to understand that better. There's also the percent of receivables method, which is the balance sheet method. And so you're not looking at your sales to determine how much to estimate as bad debt, but you're looking at what amount you have in accounts receivable. And in this case, you're going to compute the percent uncollectible from the total accounts receivable or from aging accounts receivable. So the percent of accounts receivable method assumes that a given percent of a company's receivable is going to be uncollectible. So at the end of the year, let's say you have, let's just use this example here. Musicland has $50,000 in accounts receivable at the end of the year, and their estimate or their experience has told them that 5% of that will be uncollectible. So after the adjusting entry is posted, we want allowance for doubtful accounts to show $2,500 because 5% of $50,000 is $2,500. So your entry would be well, in this case, there's going to be other things that have happened in this account. So their balance, the balance in allowance for doubtful accounts was already $200. You want the balance to be $2,500. So your adjustment is for $2,300, not for $2,500, because it's based on what you want the account balance to be at the end of the year. And you want it to be 5% of the total of accounts receivable. But if there's already other things in this account, then you may not have to adjust it for the whole amount. In this case, this account already had a $200 credit balance. You want it to have a $2,500 credit balance, so your adjustment is only for $2,300. And that's what they've done here. Again, the same entry as far as the accounts involved, just the amount is going to be different. The other method that you can use, this up here, is just taking a percentage of the amount that you have in accounts receivable at the end of the year. This method is using an aging of receivables. So the aging of accounts receivable uses both the past and the current receivable information to estimate it. So you're looking at how long a receivable is past its due date, because let's say their terms are net 30, but we all know that people don't always pay in the amount of time that they've been given. So you look at what things are, these are your accounts, these are the amounts. This is not due yet. These people still have time to pay. These amounts here are those where the people are 1 to 30 days overdue. This is 31 to 60 days, and so on and so forth. And this particular method sets up a schedule, as you can see here in this paragraph, and that's what they're doing here. And they say, okay, well, these people, they're not even due yet, but our experience tells us that 2% of this will end up not being paid. And then as you get something being past due, if it's only 1 to 30 days, experience says that 5% of this will not be paid. But as you get older, it becomes less and less likely that these people are actually going to pay. And that's why the percentages go up here. So these percentages are going to be different for every company. These are not necessarily what everybody across the country would use. It's just companies have already determined this within their own experience. And so using this method, you figure out the schedule, and then you take these numbers and add them all together, and that becomes your total adjustment. So again, same thing, you want this to be the balance let's see here, I'm sorry. Okay, they have $3,700 in accounts receivable that are 31 to 60 days past due. They estimate 10% of that won't be collected, so that's $370. So they, like I said, we do that across this whole schedule. So we need the total at the end of the year to be $2,270. It already has, allowance for doubtful accounts already has a $200 credit balance, so the amount of your adjustment is only going to be $2,070. So you want your total in allowance for doubtful accounts to be this number here, but if the account already has a balance, then you're only going to debit or credit it for the difference. So in this case, our expense account is debited, as we've done before, and then we credit allowance for doubtful accounts for the $2,070. So this is just another method for estimating your bad debts, and companies will use different methods to come up with this, but in all the cases what you're trying to do is create an allowance for doubtful accounts that is as close as possible to what might actually happen in your particular company. And then this explains, again, depending on what the balance is in the allowance for doubtful accounts, how that's going to affect how much you have to debit or credit the account. Alright, so this shows here the different types of methods that you can use to estimate bad debts. There's the income statement focus, where it's just really one way. You take a percentage of sales and do it that way. If you focus more on the balance sheet in terms of what amount should be in accounts receivable, there's the percent of receivables method and the aging or receivable methods, both of which were described up above. And then they give you some quick check answers here that you can go through and see how well you understand the material.